Okay, so I'll start, fresh start once again. I am really, as I say, really happy to host this seminar together with Loriana, because it's been for the last 2 years or 3 years even, one of my main interests to understand AI, credit scoring and discrimination. So it's also one of the, let's say, areas of research where I feel lawyers and economists work really well together, at least that there's the potential for them to work really well together. So 2 or 3 quick words on what we're going to talk about at all today. So I won't say much about what AI is or what credit scoring is, because this is what our speakers are there for. I just wanted to remind you that the EU Commission has in April of last year issued a draft, what they call AI Act. And the general idea behind this AI Act is the following: sort of like in the general data protection regulation, the EU tries to kind of come up with some high-level principles which they're going to roll out across all kinds of AI use cases. And what they have in mind is what they call a risk-based approach. So their idea is, they say, well, we have some AI use cases which don't meet legal regulation at all. And then others are really complicated and dangerous, and we're going to prohibit them altogether. And then there's stuff in the middle, and some of the stuff in the middle is called high risk. And so credit scoring is indeed, interestingly enough, lately added, late in the process, a high risk AI use case. And what does this entail? Interestingly enough, again, it doesn't say anything about the people being scored, which is, of course, what we're going to talk about today, sort of, if we're talking about discrimination and inequality. So it's not going to say anything about that. The approach of the EU Commission is to say, well, we sort of need a compliance and quality thing in between the people who build the model and the people who are going to use it. So this is the focus of what the EU has in mind. At the same time, it says the kind of relationship between the people who are going to score, or the credit underwriters, and the borrower is really nothing they're going to say anything about at this point in time. And this is still going to be relegated, so to speak, to the individual member states' private law, along with a couple of older EU anti-discrimination directives. So all of this is already very kind of interesting framework for the whole thing. We'll see how this proposal is going to move forward. As I said, it was proposed in April of last year. Right now, a number of different committees are going through their parliamentary process. The hope is that they're going to produce a joint report this fall. After that, usually what we call the trilogue procedure starts. So this is Parliament, Council, and the Commission, and ideally they would be by the end of the year ready to move forward. Of course, with the global situation right now, we don't know on which, how high the priority is going to be, but I would think at the latest sometime during next year they're going to be ready. They're hoping, of course, for sort of like another Brussels effect, and we'll see. Talia and myself have worked a lot on that cross-border. So, and one last word on the legal aspects of it. As I said, idea of the EU Commission proposal is only the quality compliance stuff, the discrimination stuff, which I hope we're going to focus on today mainly, is individual member state law, along with a couple of anti-discrimination directives. And lawyers understand discrimination, as I've learned over time, very differently than economists do. And this is why credit underwriting is such a good place, because what economists call statistical discrimination is obviously something which is kind of natural, a natural part of handing out credit. much more, I guess, than at least to the lawyer's mind, a natural part of, let's say, a bail decision or somebody hiring someone else for a job. And so statistical discrimination in that sense is something even lawyers understand and feel is necessary. At the same time, we're talking a lot about probably, two ways of calling that. In the EU, we call it indirect discrimination. In the US, we're talking about disparate impact. So we're trying to understand the consequences of going through, let's say, with pure statistical discrimination and using AI towards that goal. So it's a nice mixture in between understanding how much can AI really do, how efficient is it really, so to speak? So are we really looking at a better decision, and if so, in which cases? And that's sort of one part of the question. The other part of the question is the more normative question. Well, even if it is better in some respects, do we want to take it? Do we want to go ahead with this decision? Or are there other kind of legal redistributive concerns which we still need to keep in mind? So much, I'm not going to bore you longer with my own stuff. I'm really, really, really happy, as I said, to have this super interesting paper, which I think all three of us have not only read, but also used in our own research. So Ansgar is a professor of finance at Imperial College in London, and also a research affiliate at CEPR, and a member of the finance theory group. So Ansgar, the floor is yours. Go ahead. I'm really looking forward. Our idea as to how we're going to do this is you present for 30 minutes. If there are things which people don't understand, please feel free to interrupt and either send a question in the chat or raise your hand. If not, we would be happy to relegate questions to later when Loriana is going to moderate and also going to introduce our two moderator speakers. So thanks a lot, and Ansgar, please do go ahead.
Thank you very much, Katja, for a great introduction. I'm very happy to be here. It's actually my first time presenting this in front of a mixed audience of economists and lawyers, and I'm really excited about that. I can't wait to see what people have to say after the talk and the discussions, the Q&A. Already going to thank the Discussants for showing up and giving us their time. It's really kind of you. I'd have to acknowledge my co-authors. It's a great team: Andreas, Fuster, Paul, Goldsmith-Pinkham, and Tarun. A fun fact is that 3 out of 4 authors on this paper got a new job since starting the paper. So Andreas is now in Switzerland, Paul is at Yale, and I've moved to Imperial, and Tarun was always at Imperial. So this is our paper called Predictably Unequal, and I don't think I need to motivate it at great length because Katja has already talked about the background very eloquently. So credit scoring is one industry where machine learning is potentially being adopted by lenders to make decisions. Lenders seem to like it. There seems to be a business case for using it. Some firms are quite excited about using these algorithms to do better credit scoring. And so it's kind of clear that it's good for the producer side of the credit market. But we're here more interested in the consumer side, so the borrowers in the credit market, and in particular, the distributional effect. So who on the borrower side, who will win and who will lose if we switch from a credit market driven by a more traditional technology to one that is driven by machine learning? That's the question in this paper. And I'm going to be deliberately humble, and I'll say that we are not coming down on any side of a legal argument here or a discrimination argument. You won't even find the word discrimination in the paper, really. We are interested in describing the distribution. Okay, so we're going to have a case study where we move from traditional technology to machine learning, and we're going to use economic models to predict what happens when that move occurs in terms of different groups in the population, different distributions of outcomes. And so, Katja already said the law is changing all the time. The law is different across different countries. Economists definitely mean something different by discrimination from lawyers. So we are kind of agnostic about that, but it was very important to us to provide some solid measurement, because when we started this project, there was a lot of popular press saying this, the robots are rising and they're going to perpetuate all kinds of injustice, and all these arguments were taking place, but there wasn't a lot of measurement of what the actual effects would be of such a change, and that's what we want to explore. And so hopefully that I'll describe that quickly in half an hour, and that'll set the stage for getting the perspective of everybody else who works in the law and in other areas. That would be very interesting. Okay, so I'll go straight into a simple example that we kind of show people at the beginning. So suppose you are a lender, you observe borrowers that apply for credit, and they have characteristics that we're going to call X. That's things like their income or their credit score, etc. And what you would like to predict is the default outcome, which we're going to call Y. Okay, so Y is either 0 if you don't default on the loan, or 1 if you do. And so you want to get a predictor, which we'll call Y hat, which is some function P hat of X, which minimizes some statistical loss function like a mean square error, in the sense that it's close as possible to the true default outcome, basically. And so if you analyze this a little bit, it's not difficult to understand what happens when you go from old technology to new technology. And we're defined in the following sense. We think of old technology as this P, this function of observable characteristics that you can use to predict behavior, as being from a simple class of functions like linear functions. For example, you're running a standard regression model or a logit model that fits linear shapes to the data. That's old technology in our language. New technology is when you are able to use a wider class of functions, so non-linear functions. And that is one of the key aspects of machine learning when you compare it to traditional statistical technology. Right? It's not like econometricians weren't able to predict stuff before machine learning. You know, there's a lot of work on this, on credit scoring especially, and they're very good models. What machine learning kind of brings to the table is it's a little bit better at fitting nonlinear shapes to the data and finding more complicated patterns in the data without doing what we call overfitting, without essentially learning the data off by heart. So if you think about it in this sense, we have a little result that says that the optimal predictions that a lender makes with new technology will be more spread out. There will be a mean preserving spread of the predictions with old technology. So in some sense, you can think about a higher variance of predictions. Right? As you get closer to the truth, as you run better and better technology, you get closer and closer to knowing the true default outcome for every borrower. So these predictions will no longer be some kind of average, but they will be close to the actual outcome, and so they will be more spread out. That means that some people will win, some people will be considered a higher credit risk, a lower credit risk by the new algorithm, and some people will be considered a higher credit risk, and they will lose in the sense that they will find it more expensive to borrow. And that's kind of natural. So the question is just, you know, who are these winners and losers, and how can we talk about which groups in the population will be affected beneficially or adversely? Just a very short numerical example. It's really just a illustration, and we'll go to the data after this. Suppose that you have one characteristic X. Let's say X is your credit score along the horizontal axis in this chart, and on the vertical axis we're plotting predicted default probability. And if I'm a lender running an old-fashioned linear model, I will get a prediction that's something like this dotted straight line. Right? So as you get a higher credit score, I predict a lower default probability linearly. And if I run a more complicated technology, a non-linear one, I might find this solid black line. It might be a little bit non-linear. In this case, it's just a quadratic, just as an example. If it so happens that these are the two different predictions, you can see that the people with extreme X's, so people with either very low credit scores over here or very high credit scores over here, will lose in the sense that the non-linear technology thinks that they are higher risk, and people more in the middle will gain. Right? That's just.
Kranen has a quick question. Why is old technology linear? Wasn't classical credit due diligence like house banking with the human aggregating information surely non-linear?
Yeah, I think we're talking. I think in the US context, which is where our data is from, pre-machine learning technology didn't really involve humans very much. in the mortgage market, there was usually a model involved. And the industry standard was a logit model. So, with some tweaks that make it slightly nonlinear, which I'll discuss when we do the empirical section, but basically it's some kind of linear model. So I totally agree. For example, in corporate credit, it would be much more important to think about what Jan has mentioned. There are more house banks, there are people interacting with human credit officers, etc. People go to visit the business. And we're not talking about how you would compare that to an algorithm. This is more within an already fairly automated market, a move from old to new technology. So if you have groups in the population like blue borrowers, suppose that the blue bell curve is the distribution of credit scores among blue borrowers, and the red one is the red borrowers. Just because the credit scores of the blue group are more spread out here, we would see when you move to the nonlinear technology that the blue group gets worse off because they're more likely to have these extreme credit scores. That's just an example. It could have gone the other way around, right? The one point here is that without actually knowing how the nonlinear shape looks, without actually running the technology, you have no idea who's going to win and who's going to lose, right? Because if this nonlinear curve had ended up concave, I would have had the opposite conclusion. And another thing we're going to explore is that this exact thing can happen due to two reasons. It could be that the nonlinear technology genuinely picks up a nonlinear relationship between X and Y. That's a genuine, deep relationship. And it just so happens that the distributions of credit scores in the blue group are different from the red group, but generally the patterns we see are driven by the flexibility of the new technology. Or there could be an alternative explanation, which is, suppose we live in a world where lenders would like to include the group identity. So, red or blue, we're going to call that a variable G for group. Lenders would like to include this in the model, but they are prevented from doing so by law. Like in the US, where you're not allowed to condition on race or gender or any other protected characteristic when you're running a credit scoring model. And so if this is what they would like to do.
Okay. I have two more questions in the Q&A. Yes. Very quickly. Also, just for the people asking questions right now, please indicate whether you would like to have them in the sort I'm doing it now, interrupt Ansgar, or whether you would like to push them to later. So we have Horst Binner to ask, why would the new technology preserve the mean? And what's the exact meaning of winners and losers? And Kevin Bauer is asking, why should we expect that a nonlinear model doesn't also fit a linear trend?
Okay, Horst, I would say the mean preserving thing I'll come back to later. The winners and losers thing, we're going to have at the moment we have a very simple definition, which is just if your lender changes technology and after that change they think that you have a higher probability of default than before the change, I would call you a loser, because they're now going to give you essentially a penalty interest rate because they think that you've become riskier. And then later we'll go into an actual market outcome model that makes this a little bit more nuanced. Kevin, we should not expect that. We should go to the data and see what the nonlinear model actually does. All I was giving you is one potential example, basically. And one of my points is we really need to go out and measure this stuff to say something in the data. So you're right to be skeptical of the picture. We don't know that it's going to look like that in reality. We have to go to the data. Okay, so just to finish this, it could be that the nonlinear function isn't really picking up a deep relationship between X and Y, but it's just trying to triangulate the forbidden variable. It's trying to use nonlinear combinations of X to proxy for something like race or gender that's not allowed to be included in the model. And you can show that this can generate the exact same picture as we've seen before. But in the interest of time, let me go straight to the data. So we have in our final data set about 9.5 million mortgages in the US. That's close to the universe of mortgages between 2009 and 2013. And we have lots of information about each mortgage in the data, like, contract information, credit scores, LTV ratios, interest rates, and we also have demographics like race, gender, ethnicity, etc. And we're going to use these things, except for the protected characteristics, to predict default. Default in this case means you miss 3 monthly payments in a row. Okay, I will skip a little bit because I think there's not a huge amount of time, and the descriptive statistics, if anyone's interested, I can show later again. So the whole exercise is very simple. We're going to pretend we're a bank who wants to predict the probability of default as a function of all the observables. And we're going to do this twice. We're going to do it once with a traditional model, which is a logit. So the probability of default is a logistic function of some linear combination of the x's. And something that we were told people do in the industry is you augment the logit model with some nonlinearity. So you put in variables that are not just your raw FICO score, but a dummy variable, a 0-1 variable for whether your FICO score, for example, falls into the bin between 700 and 750 or something like that. Okay, so we're going to allow that little bit of nonlinearity just to make sure that the logit model is not unrealistically simple. We're going to do then the same thing again using decision trees, using machine learning. I don't know to what extent people are familiar with decision trees. It's kind of funny. I mean, when we started this project, there weren't many people who knew this yet. And now in 2022, most of our students know more than we do about these algorithms. So it's kind of, the world is changing very quickly. But basically what these models do, just in case people are not familiar, is they split on observables. So you start at the top of the tree and you ask, for example, is your income above or below $100,000 a year? And then if it's above, you go down the right. If it's below, you go down the left of the tree. And then you do this many times until you end up at one of these terminal nodes, which says in the end, you're either good or bad, we transform that then into a probability of default in the end. And we use something called random forest, which is a very popular technique that essentially grows many of these trees on random subsamples of your data and then takes a vote, an average vote of these trees, because that makes the model more stable, basically. So let me show you something about the performance, and then I'll illustrate a little bit what these predictions actually look like with linear versus nonlinear technology. So, the performance goes up in a statistically significant way when you shift from logit to random forest. For example, the R squared of your predictions goes up by 14.3%. The precision score, which is a measure that's common in machine learning, which asks how many of the predicted defaults are actually true defaults. You
see that Kevin is asking, do you?
Yes, I've seen Kevin's question. Yeah, I will come to that in a second. So the precision score goes up by 5.1%. I'll be very clear about the fact that these are not huge numbers. There are papers out there that find much bigger differences. So, we are not AI scientists. All of us are economists. So if you let somebody from Google loose on the exact same data with the most sophisticated neural network, I would expect them to get even better performance, right? There's in some sense, everything I'm going to show you is a bit of a lower bound on what machine learning might do. Kevin, I'm guessing you mean honest forest in the sense of the sort of Athy and Imben's literature on on treatment effects estimation and causal methods in machine learning. We didn't use that particular technique. In the end, there has to be a discussion about causality here, but we took a slightly different approach, but happy to discuss that more later on. What we're using here, if you're familiar with the literature, is just a vanilla random forest, basically. A classification model. Okay, so we sort of conclude that to some extent, random forest is a substantially better predictor of default. And let me give you an example of how this works. Okay, so in this picture, we fixed all the characteristics which are focused on two, which is the income of each borrower on the horizontal axis, and the FICO score on the vertical. And the black lines here are the level sets, or indifference curves in economics language, of the logit model. So along the top black line, the logit model predicts a probability of default of 0.1%. And then as you move to the sort of southwest of the figure, where income and credit scores are lower, obviously predicted default probabilities become higher and go to about 0.5%. But one of the properties of a linear model is that these are all sort of fairly even shapes and they're parallel to each other. And there's not much complexity in the shape of these lines. In the background, we've drawn the heat map for where borrowers live, sort of by racial group. Okay, so we're interested in differential effects of new technology across groups like racial groups. So this heat map here is for white borrowers in the US, and the sort of modal outcome is an income of around $80,000 and a FICO score of around 780. Now, if you look at the random forest, these lines are much more irregular. You know, there's lots of nonlinearity, and the random forest also penalizes much more rapidly as you move into the bottom left of the chart. As you move towards low FICO, low income people, the random forest penalizes much more quickly, which it's able to do because of its flexibility. The logit model is kind of governed by a sort of sigmoid shape of the probability function, and that makes it hard for that model to penalize a particular combinations of characteristics, whereas the random forest can really say, okay, these people with income less than 50 grand, they're quite risky. So if you then compare white and black borrowers, you can see that the region where the random forest penalizes is much more densely inhabited by minority borrowers who are more disadvantaged economically than by the majority group, the white borrowers. Right? So that's sort of one of the potential sources of unequal effects across groups that we try to highlight. What time do I need to stop? I'm just trying to think what else I should show you.
Well, you know, I mean, given that we're also answering questions as they come, I'd be happy for you, unless Loriana disagrees, to talk another 5 to 10 minutes.
Yeah, that's fine. I will. So in that case, I'll discuss these results in detail, and I will have to skip what our economic model that's a little bit more complicated, that puts us into a market equilibrium. But I'll advertise that quickly at the end, but I unfortunately won't have time to go into the details. So one way to visualize what happens in terms of unequal effects that we found useful is this chart here, which I'll explain in detail. So on the horizontal axis, you've got the difference between the log of the predicted default probability that borrowers are assigned by the random forest model and the log of the predicted default probability that they are assigned by the logit model. It says nonlinear logit here only because of the bin dummies that I mentioned before. And if this difference is positive, it means that you are what I called a loser, in the sense that after your lender changes technologies, they consider you more risky. And if this difference is negative, you are a quote unquote winner. Okay, again, that might be provocative language to call them winners and losers. I really just mean PD goes up or PD goes down. Okay. So on the vertical axis here, we have the cumulative share of borrowers within each racial group that obtain a certain value of this difference. So let me give you an example. If I read this off at 0 and I go to the white group, the green line, I can read off that around 62% of white borrowers will have a difference of at most 0. Okay, so about 62% of white borrowers, after their lender changes technology, are assigned a lower PD than before. Right, so those would be sort of winners. Okay, so, and one thing you can see here is that the proportion of winners is around the 62-65% mark for the white and the Asian group in the population, who are sort of economically more advantaged on average. And it's around 50% for the white Hispanic and Black segments of the population, which are historically more disadvantaged in the US and have less access to credit. And so the people that already have more access to credit are more likely to gain from this new technology, according to this metric, which is something that, you may or may not worry about. Again, you might say that this is just lenders becoming more accurate, right? And so they are doing what economists would call statistical discrimination, and what more broadly you might just say is a rational response to costs, right? If you're more able to estimate the costs of doing business with somebody based on their observable characteristics, and if you haven't broken the law by putting protected characteristics into the model, maybe whatever happens is fine, because it's just a more cost-sensitive way of doing business, right? Or you could say, look, as society, we often have some intrinsic aversion to inequality. So if access to credit is becoming more unequal, maybe that's something we want to do something about in terms of policy. I cannot give you the answer for which is the right view of the world, right? So that's a political question, a philosophical question that economists shouldn't really be in the business of answering, right? There's a lot of debate about this. Computer scientists are coming up with lots of different ways of defining what would be a fair algorithm. Lawyers are talking about what should discrimination law look like in an AI-driven world. And we're staying agnostic and just describing the effects. But, in general, in economics, we have something called Arrow's impossibility theorem, which says that there is generally, without making value judgments, without making some political statement, there's no unique way to decide what's the fairest or the best allocation. You have to take some kind of stance on the underlying philosophy. Okay, so another thing I'll just quickly point out before I finish is we try to decompose the differences between logit and random forest into flexibility and triangulation. And I probably won't have time to go into exactly how we do this. The details of that technique are in the paper, but we find fairly convincing evidence that we are not in a world where the only purpose of machine learning is to put race back in the model through the back door. We're not in a world where the main purpose of machine learning is triangulation. Flexibility seems to be a large part of the story behind the results that we find. That's not to say that these are not unequal effects, right? Again, if you care about inequality and you want to equalize access to credit across racial groups, you would still not like this, right? Even if it's not driven by triangulation. But again, that's something that we need to debate in terms of policies and in terms of politics. Okay, then I'll just quickly advertise we go further by saying, suppose I'm a lender who uses these predictions to price loans in a competitive market. Okay, so I use these predictions to decide, first of all, who gets access to credit and who gets rejected. And second, among those that get access, what is the interest rate that they get charged? And just the sort of high-level facts that we find there is that there's some silver lining to the inequality story, because it seems like access to credit becomes more equal when we move towards machine learning. So lenders are more able to give access to credit to, say, Black and Hispanic borrowers that with traditional technology weren't accepted for credit. On the other hand, on the interest rate side, you see the exact same unequal effects that I've already highlighted. So Black borrowers are more likely to get charged penalty rates, basically, than white borrowers. And there's a lot more dispersion within the minority groups too. So there are a lot of, for example, among the Black borrowers, there are a lot of them that have great observables from a lender's perspective that don't look like high credit risks. And so they get rewarded a lot by the machine learning algorithm, whereas those that are disadvantaged and that don't have great observables get penalized even more. So
there's a question, Ansgar, on gender, on data on gender.
Yeah, we haven't done it with gender because we just wanted to submit it to a journal as quickly as possible after we found this stuff. And then we all got new jobs. So the problem then was that Paul and Andreas used to work at the Fed and have all this data, including the gender data, but they got new jobs, so they weren't able to pull it. So that's why we stopped here. But I don't think it's any less interesting to study gender in addition to race. I think that's an interesting open question. So yeah, in terms of equilibrium, we find slightly, the extensive margin results about inclusion and exclusion from the credit market tell a slightly more positive story than the interest rate results. And this is not the most complicated structural model of the credit market that you could estimate. It could be more sophisticated, but we thought it was interesting to put this through an actual economic market clearing model to see what would happen. Okay, I think I'll stop here, and I'll really look forward to the discussion. Thank you all very much.
So thank you very much, Ansgar, and I'm very happy to thank Talia and Aislinn that has accepted our invitation to, let's say, provide comments on your paper with two different perspectives. So let me just introduce our two discussants. So Talia Gillis is Associate Professor of Law at Columbia Law School, and she studies the law and economics of consumer markets. She's interested in household financial behavior and how consumers' welfare is shaped by technological and legal changes. And Aislinn Kelly-Lyth, I hope that I'm pronouncing well. She's a researcher on algorithm management at the Bonavero Institute of Human Rights. That is an institute at the University of Oxford, the Faculty of Law. Her research focuses on regulation of technology in the employment context, including equality law and data protection law. And she will comment mostly your, let's say, analysis from the point of view of the UK Anti-Discrimination law. I think that I'm happy to give the floor first to Talia, and thank you very much again for spending your time with us today.
Excellent. Thank you so much. I'm gonna just share my slide. Okay, so I'm so grateful for the organizers and for Ansgar to have this opportunity to comment on the paper. I really remember the first time I heard this paper being presented. It was at the Household Finance Summer Institute, and there was just such a sense of excitement around the paper and around the ideas in the paper. It was a time in which people weren't really thinking that much about algorithmic credit scoring, and it was just such a pleasure to go back and read this paper again in preparation for today. And it's, despite the fact that today so many more people are thinking about credit scoring, about kind of use of different statistical methods of credit scoring, it's just amazing how insightful the paper remains, and it just has so much in it, and really tries to think through the different elements related to algorithmic fairness. So I'm really, really a fan of this paper. I think it's fantastic, and I think it continues to be a real guide, both to my own research, but to many people who are thinking about this topic. So I have a PhD in economics, but I now teach at a law school. So I'm really interested in the intersection between the kind of empirical study of these issues and how we should think through them in the legal context. And so just to highlight and this was mentioned by Ansgar. So when we talk about algorithmic credit scoring, we often kind of talk about these three related but kind of really separate phenomena. So I just want to kind of highlight that. So there's three things in a way. The first is automation, this idea that decisions perhaps are moving from a world in which there's some kind of human discretion in setting credit terms to a world in which it's much more automated. So it's true, credit scoring itself was not typically a process that involved human discretion, but setting the final terms of loans and mortgages definitely traditionally involves human discretion. I mean, that's definitely something we need to keep in mind when we look at the HMDA data. All the data we have in HMDA in terms of loan decisions and interest rates are partially a function of decisions made by brokers and loan decisions. So sometimes when we think of algorithmic credit scoring, it's that move to automation. The second move is kind of the move to use alternative data in credit decisions. So if it's kind of historically, we looked at a fairly limited number of variables, kind of a person's income, the loan to value ratio, other kind of standard variables. We're now looking at a world in which kind of alternative, many other kind of sources of data are being used to assess credit worthiness. And the third is kind of the change in the statistical technology used for these types of assessments. And really the paper's focus is on that third element. And that's one of the really nice things about this paper, is that it really kind of focuses on kind of isolating the impact of that third element, even in a world in which we have multiple changes going on. Sorry for the the ambulances. Okay, so in my comments, what I'm going to try to do is try to do exactly what Ansgar and his co-authors avoided, and try to think through what are the legal implications for discrimination of the paper and its finding. So I'm relatively new to law teaching, but one of the things that I've learned kind of in my short time teaching law is that you always teach through hypos. So I'm going to kind of explore the issues of the paper through this hypo. And hopefully this will be somewhat useful to explore kind of US doctrine when it comes to fair lending and what we might learn from the paper for fair lending. Okay, so Marvelous Mortgages, which provides household mortgages in the US, recently attended a Lendit conference. Lendit is a real conference. They're really excited about AI, and they now want to use machine learning techniques to make loan decisions. For budgetary reasons, they can't do anything with respect to the data they use or collect, so we're keeping that constant. But they now want to move from a logit model to a random forest, like in the paper. The Center for Financial Equity decides to file a class action claiming discrimination under the Equal Credit Opportunity Act and the Fair Housing Act. Okay, so what we're going to do is we're going to try and think about how this is going to play out. Okay, so just to highlight fair lending in the US, just to say a few words about the law in the US. Fair lending is kind of assessed ex post based primarily on two acts. The first is the Fair Housing Act, which deals with discrimination in many housing related domains, of which kind of mortgages is just one. And the Equal Credit Opportunity Act, or ECOA, deals with discrimination in many credit markets, so not just mortgages. And these two, somewhat controversial, but these two acts have been recognized as including both a disparate treatment and disparate impact doctrine. So disparate treatment dealing with some kind of direct conditioning on a protected characteristic, and disparate impact dealing with facially neutral rules that end up in some kind of impermissible disparity. Okay, so let's see how this might play out. So I'm actually going to start with disparate impact. Disparate impact has what's known as this burden shifting framework. Okay, so we've got the plaintiff. Our plaintiff is the Center for Financial Equity, and our defendant is Marvelous Mortgages. We have this burden shifting framework in which kind of the Center for Financial Equity is going to try and show that a policy or practice has some kind of disproportionate effect on a protected group. This is what we kind of think of as the showing of disparity. At the second stage, the defendant, so Marvelous Mortgages, will try to show that that policy that might have resulted in disparities can be justified, it's justifiable. And in the third stage, and it's not 100% clear who has to prove this, but let's say it's Marvelous Mortgages also has to show that whatever legitimate interest it has can't be achieved by a less discriminatory mean. This is, or a less discriminatory alternative. People in the know just call this LDA. Okay, so let's think through kind of each stage here. Okay, let's start off with the showing of disparity. And kind of for simplicity, what I'm going to do is I'm going to assume that the disparities are all really about showing whether we're doing better or worse than the status quo. Okay, that might not be the standard for disparate impact, but let's, for simplicity, kind of decide that it's all about kind of comparing the change or the policy relative to what took place before a change in policy. And so how can the Center of Financial Equity essentially use Ansgar's paper? And So one way, and this was kind of highlighted it in the presentation of the talk. It's funny that I choose the ones without the log, but essentially this is our graph of the winners and losers. So the negative people are people who are doing better under the random forest than they were under the previous technology of LoJet. And as was pointed out, a higher proportion of white, non-Hispanic and Asian borrowers are doing better under this change in technology. Okay, so if this was the relevant metric of disparity, then we might say, hey, the Center of Financial Equity has kind of met its burden. It's shown that this change in policy resulted in some adverse impact on a protected group. But what makes this kind of not simple at all from a legal perspective is that in some ways, this is an assessment of creditworthiness, but it's not really the lending decision itself. And so what's really nice about the paper is the paper gives us some sense of actually how this assessment of creditworthiness might translate into actual lending decisions. And so it engages in this exercise in which it makes some key assumptions to give us kind of market equilibrium decisions. Obviously, I have a lot of reservations about the assumptions made. I think the authors do as well. So everything should be taken with a grain of salt, but it's very, very helpful because it doesn't just stop at kind of, this is the assessment of creditworthiness. It's really trying to think through what that means for actual real world lending decisions and outcomes. Okay, so the key assumption to some extent is that we have this competitive market, and essentially a lender calculates the net present value for each borrower and essentially selects the interest rate for which they break even for that borrower. That's kind of I guess the heart of the exercise. And when you can't break even, you reject the loan. So when we look at the results of that exercise, right, and if we focus just on the acceptance rate, then actually we see that all acceptance rates goes up to some extent, but those who enjoy the most from the increase in acceptance rate are actual racial minorities. I point this out because if this is our relevant metric, right, if what we care about is acceptance rates for loans, then actually it's going to be hard for the Center of Financial Equity to establish some adverse impact on a protected group. But if our relevant metric is the interest rate and not whether you got the loan or not, then that doesn't look so good because the kind of the spread at origination of the average interest rate is kind of more negative under the new technology. Okay, so I guess the bottom line from looking at all of this and analyzing the paper is, first of all, we can ask ourselves, how do we judge disparities? For this first stage of disparate impact, how do we judge disparities? In absolute terms, in relative terms? And even if it's just in relative terms, which disparities? Is it creditworthiness predictions? Is it loan decisions? Is it the interest rate? These are all really complicated questions. And actually, the publicly available HMDA data set that the paper uses really only reports acceptance rates, right? So ironically, by the information collected by the US government, or that mortgage originators are required to, really actually highlights the acceptance rate as kind of an important factor to judge disparities for protected groups. So this is very complicated. I mean, another question that might be outside the realm of fair lending is, what about a situation in which disparities increase, but overall welfare does better under a new technology? That might be outside the realm of fair lending, but that's another question from a policy perspective that we would ask ourselves. Okay, so let's assume that the Center for Financial Equity has overcome this burden and has shown that the change in technology increases disparity. Now, marvelous mortgages will come back and try and say, hey, it's true I changed the technology, but I have a business justification for changing that technology in moving from my LoJet to my random forest. And so what is a business justification? So one possibility is that a business justification is that I can say that a lending policy is justified if it creates differential treatment on the basis of credit risk. So credit risk is my criteria for this policy, and that makes that disparity justified. So in many ways, if that's true, then perhaps using this paper, Marvelous Mortgages is able to defend its practice by saying perhaps it increased the interest rates or the disparities in interest rates. Perhaps it kind of created more dispersion in creditworthy assessments, but that's all justified because it's all on the basis of creditworthiness assessments. So on its face, maybe Marvelous Mortgages might be able to kind of defend itself successfully. Of course, just a few kind of comments about thinking through this business justification. The first is, and I guess because I've been in charge of kind of the US markets, one thing to highlight, and this is a thing that kind of is mentioned in the paper, but it's very important to understand when we think about these issues within the US market, is that it's not clear that mortgage originators in the US, for the most part, really care about creditworthiness assessments. And that's because the vast majority and this has fluctuated over the years, but the majority of kind of household mortgages are not kept on the balance sheets of the mortgage originators themselves. They go to secondary markets and primarily to the government-sponsored enterprises, to Fannie Mae and Freddie Mac. And so that means that if I'm a mortgage originator providing a loan to a consumer, which will then be just sold nearly immediately to a government-sponsored enterprise, what I care about is really the price I'm going to get from the government-sponsored enterprise and not my true assessment of the creditworthiness of the consumer. And what's really interesting is the way that the government-sponsored enterprises price how they price loans is very, very coarse. So it's basically primarily just on FICO scores and loan to value ratios in these big buckets. So if the secondary market or the biggest buyer of these mortgages actually is pricing in these big, big buckets, there's this question we can ask ourselves as a real world implication: does this creditworthiness assessment really matter? And just to give you a sense of the proportion, so we have kind of in the light gray, we have the proportion for each year of those household mortgages that are sold to the GSEs, and it's really quite a high proportion. So it's not quite clear that Marvelous Mortgages can come back and say, hey, I have this great dispersion in prices, but it's related to creditworthiness, when in fact they don't hold the credit risk. It's just kind of immediately sold, and they primarily just care about the cost from the GSEs. Another thing I wanted to highlight is that in reality, mortgage differentiation is not only risk-based, okay? This is something, so the paper really is fully focused on, and at least the model is fully focused on a world in which price differentiation is all about credit risk. But that doesn't seem to be true. It doesn't seem to be true because very often it involves other costs, right? Other costs, we might price mortgages differently based on the cost of origination and servicing. It might be different based on kind of different risks of prepayment, which is something that's recognized in the paper, even though it doesn't enter kind of the equilibrium model or assumptions. But one thing I really want to highlight and kind of maybe put in kind of a placeholder for where I really think we need research on this, empirical research on this in the future, is that we know, well, we have indications that a lot of price differentiation in mortgage markets is based on consumers' differential willingness to pay for a loan. So some people face less competition when they're shopping for a market. Some people are less financially literate. Some people just kind of from a behavioral perspective shop less for good terms. And all that we know factors in to pricing of mortgages, right? We know that people come to the mortgage broker and say, match this better offer or try to negotiate something else. And if that's going to impact the actual interest rate, then all that is part of the pricing. And so it's not just risk-based pricing. And so one of the things we'd have to think through with Marvelous Mortgages is the extent to which all its price differentiation is explained by risk, by differential risk. And the second question is whether this would be a business justification. If Marvelous Mortgages comes and says, yes, I have some price differentiation, it's based on people who had a competitive offer and that ended up in differential rates for black and white borrowers, if that would be a business justification. Let me quickly kind of mention the last element. So let's say marvelous mortgages did establish this business justification. It might still come back and we say, yeah, marvelous mortgages, you can price differentiate based on risk, and that's fine, even if it results in differential prices for black and white borrowers. But perhaps there's a way to account for that risk in a less discriminatory way. And what's kind of interesting about the paper that talks to this issue is that to some extent, it might suggest that using a more advanced technology is required from mortgage originators, right? If, let's say, the criteria we were using was acceptance rates, and we were able to show that actually, so let's say marvelous mortgages was using a random forest, but actually, you know, there's a more advanced machine learning technique that does a better job at predicting creditworthiness, or the same job at predicting creditworthiness, but results in less disparities. Perhaps there's a legal obligation to use that technology. And so that's something perhaps that's indicated by the paper, that maybe a mortgage originator using a logit, right, in Ansgar's world is using logit, might now actually be obligated to use a random forest because it results in kind of less disparities in acceptance rates. So that's one thing that's pretty interesting. Maybe I'll just kind of put in one quick mention of why I think this the paper's really raises interesting issues in this context, but also one thing we need to keep in mind is how, from a policy perspective, the results might not necessarily generalize, right? Particularly if we move to slightly different populations, different technologies, or different data, and how that's very important when we think through less discriminatory data. So I'll just skip this. So I actually wrote a paper that I did not benefit from a Fed co-author. So I didn't have this marvelous data set that's used in this paper. And instead, we had to simulate default rates instead of using default rates. But actually, our simulation of default rates used the summary statistics in this paper. So this paper was very useful in our simulation exercise. But one of the things we do a similar thing where we used a random forest to predict creditworthiness using the Boston Fed HMDA data. And we have some algorithm that's giving us the prediction of creditworthiness. And then we apply that algorithm, that pricing algorithm or prediction of creditworthiness, to two subpopulations in the Boston metropolitan area. So on the left, we have kind of the urban Boston area, and we plot it separately for minority and white borrowers. So these are the disparities in the prediction of creditworthiness for minority and white borrowers in kind of using the same algorithm. On the left, it's in the Boston urban areas. And on the right, we have kind of the more rural Boston areas. So we're keeping fixed our pricing algorithm, but just applying it to slightly different populations in the Boston metropolitan area. And you can see the disparities are very different depending on who we apply it to. And so this is something very important to keep in mind as we talk about these disparity measures. They're really not stable measures. They all really much are sensitive to the particular population that you're applying them to. Okay, I feel like I've talked so much, but I just want to get to my discussion of kind of disparate treatment, which I think is very important. So I started with disparate impact, which is how this case might fare in a claim of a neutral rule that ends in disparities. But the paper raises very important ideas with respect to how a disparate treatment claim might play out in court. Why does it change? So one of the nicest things about this paper is that it really tries to get to this question of why does a change in technology cause an increase in disparities of scores? What might be driving that? And it distinguishes between the idea of the flexibility and the triangulation, where flexibility is built off the idea that the baseline characteristics for minority and white borrowers are different. And so machine learning increases the flexibility that could amplify the impact of these pre-existing differences in the baseline covariance, okay? And so that if the explanation is flexibility, it's not just disparate treatment. It might be disparate impact, but it's not disparate treatment. But triangulation deals with the structural relationship between race and default that's essentially recovered by machine learning. And that might be disparate treatment. okay? And so the exercise of distinguishing between flexibility and triangulation from a legal perspective is very, very important, because triangulation will raise disparate treatment concerns and can't be justified using kind of the business justification. Okay. I want to take a moment to think about why, focusing on triangulation, why would it be that race adds information? Okay. And this is choppy waters and it's sensitive, but I think we really need to think, why is it that a person's race has this relationship to default? Okay. Now, from a legal perspective, we might not care. We can just say formally, if race is used in your decision, it doesn't matter the source of the connection between race and default. But I think we perhaps should really care about why it is that race is changing, has this relationship to default. And I want to suggest that one explanation might be the omitted variable bias, right? Perhaps there's data we don't observe that race is proxying for. And so race is providing us this information, but what it is really a proxy for something else we don't observe. We don't observe a person's wealth, perhaps race is providing a proxy for wealth, and that's why we have triangulation. That's a very different explanation by saying that there's some relationship between race itself and the default risk, right? So for example, an example that I really like, suppose a black and white borrower, they go into a mortgage originator, they have the same job, they have the same degree, they have the same income, they're identical across all dimensions except their race. And we're running some prediction of your payment ability in 20, 30 years from now, okay? Because of labor market discrimination, we might say that race itself will cause the black borrower to have a higher risk in 20 years than the white borrower. So it's race itself. It's not that race is kind of a proxy for something else we don't observe. It's race itself, okay? And the reason it matters is that perhaps with omitted variable bias, the more information we have, the more we observe, this will go away. Eventually, race won't matter at all for any of these predictions. But in that second story I told, race will always matter. Doesn't matter how much information you come in. So even maybe from a legal perspective, we don't care about those two explanations. We just say you used race, that's all we care about. Perhaps kind of as people who are investigating this empirically and from a policy perspective, we really should care about these two things.
Talia,
Okay.
Yes, thank you very much. I think that we get your point, and I'm extremely fascinated, but unfortunately the time is running. Yes. So I suggest that we are moving to Aislinn. I think that Ansgar, you have so many things to think about, and provide then later on a short answer to all the points that Talia pretty much tried to point to, that are clearly not easy issues. So Aislinn, please.
Thank you so much for inviting me to speak today. It's been really interesting to read this paper. I should give a disclaimer that I'm not an economist, unlike Talia, although this is my second machine learning and economics paper I've presented in the last few days, so I'm getting familiar with some of the language. I saw Talia present a fantastic paper at Harvard Law about 3 years ago now, and it has really sparked my interest in this area. So yeah, it was great to read this. So I'm going to speak from the perspective of UK law, but I should start by saying that it's kind of the same as speaking from the perspective of EU law, so there's not really a distinction here. EU law kind of sets a baseline in terms of discrimination law in Europe or in the EU, and then EU member states kind of build on that framework. And the UK's position is still very much the EU position, and it doesn't look like that's something that's going to change despite Brexit. So my discussion will really be about both regimes. And much like US law, there are two types of discrimination in the EU and in the UK. The first type is direct discrimination, which broadly maps onto disparate treatment. And the second type, indirect discrimination, broadly maps onto disparate impact. But as I'll come to explain, they're not perfectly mapped onto one another. And I'm going to start in the same direction that Talia started, which is by starting with indirect discrimination. So this is the description of indirect discrimination that we find in EU law, and that's transposed into most member state law. So this one is taken from the Racial Equality Directive, which applies to various domains, including goods and services. but the same analysis applies in gender and various other protected characteristics as well. So basically, the way that indirect discrimination works is that you will identify a provision, criterion, or practice, which we use the shorthand PCP, which puts this protected group at a particular disadvantage. So, for example, it puts people of a certain ethnicity at a particular disadvantage when compared with other groups. So we can see clearly, and as I think I don't need to go into too much detail because I think as Talia explained really well, we can see how this could clearly map onto an algorithm of this type. So the practice could be offering loans to people who receive a certain probability of default, or not offering them to people who receive a certain probability. Of course, the question would be whether that actually happens. But if we can see that people of a certain probability default are not receiving loans, and we can see that Black and Hispanic groups are more frequently receiving low scores, then we could see that the use of this algorithm is putting them at particular disadvantage. So we would then move to this second stage, this justificatory stage, which again exists quite similarly in EU law. And the question will be whether the use of this algorithm to make these decisions is objectively justified. And that's a kind of two-step analysis. So first you would ask whether you have a legitimate aim in using this technology. And then you would look at whether the means used are actually proportionate to the aim. And just thinking back to this algorithm, if we were moving into this machine learning algorithm, I think there would be a chance, as Talia explained, of success at this justificatory stage, because if you can show that there's a higher accuracy and you can show that there's actually higher acceptance rates, even for the otherwise disadvantaged groups, you might argue, or the bank might argue, that the harm is not so great, especially given the gain. However, that would be a question for the court, so that would be a question of fact. And what they would do would be look at exactly the type of data that's in, or the type of explanation that's in this paper. So they may well bring in expert evidence, economics papers to analyze whether the kind of ends are justified by the means. So it's ultimately a balancing paper. And it's really important to note at this stage that for this indirect discrimination framework, the causes of the bias are irrelevant. So the Supreme Court in the UK recently was asked the why question, which was in a case called ESSEP. The case was about a test that was being used for promotion, and it was shown that ethnic minority groups and older workers were not doing so well in this test. And the employer said, well, you have to explain why you're not doing so well in the test in order to bring an indirect discrimination case. The Supreme Court said that's not how it works. If they can show that they are not doing so well in this test, the burden is on you to justify the use of the test. So you have to actually show that the benefit of using that test outweighs these harms. So the questions like whether this stems from flexibility or triangulation are not relevant to this type of analysis, to this indirect discrimination analysis. And when I looked at this in the context of hiring technologies, that was really the type of analysis that I used recently. So I looked at whether how indirect discrimination law would apply. And I really found that actually we already have a system which creates this kind of balancing test, harms versus gains. And really in previous work, I looked at how we ensure that those outcomes are actually realized, how we get cases before the courts. But I was giving this paper at a seminar in Oxford about 6 months ago, or actually almost a year ago now. And one of my colleagues, Ruben Binns, who's in the computer science department, asked why my focus was so much on indirect discrimination. Because the concept of direct discrimination in EU law is not equivalent to the concept of disparate treatment in US law. So direct discrimination in EU law is the concept of someone being treated less favorably on grounds of their protected characteristic. So you can see how that's different from the US framework in a sense, because there's no focus whatsoever on intentionality or explicit classification. So I'll come back to that in a second. I just want to briefly mention one thing, which is that clearly if we do have explicit classification, if a model is actually directly using something like race or gender, then direct discrimination will have occurred. And this is not an impossibility. Actually, this is a case from Finland, only from 4 years ago, in which actually this was directly being used by a credit institution. So it goes without saying that direct discrimination certainly arises where protected characteristics are explicitly used. But the point is that in EU law, we actually have a broader conception of direct discrimination. So we realized when we started looking into the literature on algorithmic fairness that it has been heavily influenced by the US literature. Because most of the early literature in kind of 2015, 2016 onwards was coming out of the US and being pretty much transposed into Europe because the regimes are so similar. But in reality, this has meant that the concept of direct discrimination has been quite underexplored, in particular, the distinction between the two types, between direct discrimination and disparate treatment. Because as I mentioned, there's no need for intention or for explicit classification within EU law. So just to give an example of what this would mean, in the 1970s and 1980s, there were cases about pregnancy discrimination. So if you, for example, treat someone differently because they're pregnant or exclude pregnancy from a disability plan, is that direct discrimination against women? So in a case called Gilbert in the US, the Supreme Court said no, because pregnancy is not being used as a pretext for sex here. It's not that we're basically inferring sex into the decision-making process. And there was an interesting dissenting opinion. And a few years later, the EU court, the highest court in the EU, came down on the other side and said, yes, this is essentially equivalent to discriminating on the basis of sex, and actually followed a reasoning that was very similar to Justice Stevens' opinion in Gilbert. So it's interesting to think of that as an example. Obviously, both legal frameworks have moved on in the last 30, 40 years, but they're still grounded in these fundamental distinctions. So as I said, this was about a year ago now that I mentioned this, that we started discussing this topic. And after delving into the case law, we finally finished a paper which is about to be published in the Modern Law Review with my colleagues, Professor Jeremiah Adams-Prassel and Professor Ruben Binns, who work in law and computer science respectively. And what I want to do is think through briefly how our findings would apply to the type of algorithm that's discussed in this paper. Because as I mentioned, the indirect discrimination analysis is broadly similar to the analysis in the EU. So firstly, thinking about the idea of triangulation. So the paper, as was mentioned, describes two mechanisms by which these unequal effects can arise. And the first one is triangulation. So I'll take them in turn. And when I was reading the paper, it reminded me of a philosophy paper we had read in the course of writing this article, which is by my colleagues Benjamin and Thomas, who work in the philosophy faculty at Oxford. So they proposed a hypothetical example of a recidivism prediction algorithm, so an algorithm for the criminal justice context, which could perfectly proxy for race. So that if you actually put race into this model to predict recidivism, it would have an impact. And this really reminded me of what was being done in a more empirical terms by the paper that Ansgar presented. And they go through this question from a really philosophical perspective. So they ask, would this classify as direct discrimination? And what we wanted to do was think about it from a legal perspective. And I could see that this was also something that was kind of in the back of the minds of the authors of this paper, because it does seem as though triangulation effectively reintroduces this protected characteristic. So in the paper with Jeremiah and Ruben, we concluded that actually this would classify as direct discrimination under EU and UK law. So how do we get to that conclusion? Well, given that we don't have intention as a kind of touch point or explicit classification as a touch point in EU law, we have to have some kind of broader conceptions of what constitutes directness for the purpose of direct discrimination. And one of the ways in which direct discrimination is understood to occur in EU law and UK law is through the use of an inherently discriminatory criterion. So if a criterion is so closely linked to a protected characteristic that it's almost impossible to extract them from one another or extrapolate them from one another, then that's understood to simply be direct discrimination. So a very simple example would be if you were deducting 5 points from everyone who attended a girls' school, that would constitute direct discrimination because attendance at a girls' school is clearly inextricable from gender. But it doesn't have to be so straightforward. So, for example, a very recent case before the European Court of Justice was about the wearing of displays of religious, philosophical, or political beliefs. So the question was whether that rule, an employer's rule against the wearing of such manifestations, was direct discrimination. And the court said no, because it's just a general neutrality rule. But if you make it a rule only against the wearing of conspicuous signs of religious, political, or philosophical belief, then that becomes direct discrimination potentially against Muslim women. because Muslim women are so directly affected by this rule, which really affects them much more than anyone else, that they are actually being directly discriminated against. So we can see that this concept of what is inherently discriminatory criterion is broader than something that immediately intuitively links in to the protected characteristic. And I can give a bit more explanation about that if people are interested, because there's a huge amount of case law on this topic, and it's extremely complicated, as we found as we were doing this research. But as a thought experiment, we considered how this could map onto this perfect proxy question. And we realized that if you're using more than one criteria, multiple criteria in combination, and the application of those criteria in conjunction with one another put a particular group at an extreme disadvantage, then that would be essentially equivalent to a single discriminatory criterion. So if we think of an example of a school that was previously a single-sex school, but started admitting girls in 2010, we could imagine an employer who didn't say, well, I'm going to minus 5 points for attendance at a girls' school, but they did say, we're going to minus 5 points if you attended this school and were born before the year 1990. So you could see that in that case, no woman would be able to satisfy that criterion of the employer. So this would be an inherently discriminatory criterion, even though it's actually two criteria being applied together. So we don't need like a single inherently discriminatory criterion. It's satisfactory to have, we argue, multiple criteria which have the same effect as a single discriminatory criterion. So this is the conclusion we come to in our paper. We say that even if you have multiple criteria, if they acting in conjunction with one another constitute a perfect proxy for a protected characteristic, then direct discrimination does arise. Because if you're applying all of them in this way, it's essentially equivalent to applying a single inherently discriminatory criterion. Because, for example, everyone who comes from a particular ethnic background is having a certain outcome as compared with an equivalently placed person of a different ethnic background. And it's important to recognize that because of the absence of the relevance of intentionality, there doesn't need to have been any human who was aware of this happening. So if no one had done the analysis in this paper, but there had been complete triangulation, and then someone found out down the line that they had consequently been denied a loan, the credit institution would then be liable for direct discrimination under our analysis. Obviously, the access to that evidence is another question, and not one that I'm going to get into today, although I have spoken about it in the past because it's probably the biggest issue in this area. But it's important to recognize that this doesn't have to have human recognition in any sense. So that's triangulation. But as was discussed, triangulation was not found to be kind of the main cause of the unequal effects in this case. And one really interesting question is, what conclusion do we come to if we find that the outcomes are caused partly by triangulation and partly by flexibility, even if it's mostly flexibility? If it's 30% because of triangulation, can we still conclude that this is direct discrimination? Well, I would say that that's not going to be a straightforward argument, because there's some quite confused case law about the use of various criteria acting in conjunction with one another. It would be a difficult argument probably to make. It would be quite a novel argument to make in court. And part of the reason is because the human mind is a real black box. So often with decisions, we can't really distinguish what percentage has been because of what cause. But if we could say that any element of triangulation creates a presumption of direct discrimination, and the claimant can show that it's more likely than not that triangulation is occurring, then the burden would be on the credit institution to show that triangulation was not occurring. And from what I understand in the paper, that would be very difficult to show. So this could definitely be a potential risk if we think that actually using this machine learning model could be more accurate and open more access to people for credit. But as I said, it's not a clear-cut case that triangulation, any element of triangulation will necessarily result in a finding of direct discrimination. If then we find that it's mostly flexibility driven, how do we deal with that legally? So in my paper with Ruben and Jeremiah, we spend about 2/3 of the paper looking at the established understandings of direct discrimination to explain how even the kind of established understandings by the judiciary would mean that some machine learning algorithms do directly discriminate. For example, those that triangulate in the way described in this paper. But what we do in the last third of the paper is take a step back and think about what it means for a protected characteristic to be far upstream. And what we found was that there's a real lack of clarity in the case law on the meaning of the words on grounds of, or in UK law it's been translated as because of. And we actually raised this question in some depth in the paper, because really the judiciary have not wanted to go into a legal causation analysis in the context of discrimination law. You can see in the case law that they feel quite uncomfortable about applying what we call in law a but-for test. So but for their race, would they have had this outcome? The judiciary have really edged away from that as being too simplistic, but then they've also edged away from using terms like significant influence, which have been proposed at various points. And we worked this through in the paper in the context of the Gender Shades project, which was launched, as probably most people know, against was analysing the outputs of gender classification algorithms, which were less accurate for women with darker skin. And we thought about whether that would be direct discrimination. And our sense intuitively was that it should be direct discrimination, and we go through the kind of normative arguments about that in the paper, but it's very hard to fit into the established doctrine. And we find that it really comes down to what we understand as because of, because often we'll find something far upstream. So in the Gender Shades case, the algorithm was less good at recognizing darker skinned women because they have been trained on the faces of politicians. And those politicians were majority white men, or were disproportionately white men. So can we say that a woman who is not recognized by an algorithm in that context has not been recognized because of her gender and race? Well, it's very difficult to answer that. But when we think about the human counterfactual, it does seem to be direct discrimination. So, for example, Uber uses a facial recognition technology to log their drivers in when they're driving for the app. And there's been an indirect discrimination case brought against them. But if someone fails to be recognized by the algorithm, and you can show that that algorithm is less good at recognizing Black women, for example, could you say that she hasn't been recognized because of her race? Well, think about if it was a human manager. The human manager would never be able to say, well, I'm simply not as good at recognizing you because I haven't been exposed to as many people from your ethnic or gender background. That's not something that we would accept from a human. What would happen with a human is that they would come up with a different reason. So they would just say, I'm a bit tired today, or I haven't seen you in a few weeks. So we have much greater traceability in algorithmic decision-making, but it also is a bit of a Pandora's box, because we can then trace the protected characteristics upstream. So most of these unequal outcomes will be able to trace back to something in history that has created that inequality. So I want to close by mentioning this paper from some of the main fairness and machine learning scholars in this area. And they point out that discrimination law is at best an incomplete mechanism to remedy historic injustices. And I think this is what we really came away with in this research, was that when we have an algorithm like the one described here, where we can see that some of the unequal outcomes are traceable upstream, that they're probably because of historic inequalities in society, we ask, at what point does discrimination law have to hold up its hands and say we can't do much more, and we need to look more at proactive mechanisms in the law? Because we can't always pin things on these decision makers at discrete instances in time when they're working in a fundamentally unequal system. So I've spoken really about discrimination law today. Yeah, no, that's everything. I just wanted to mention that data protection law is also very relevant here, but I haven't spoken about it today in the interest of time. But if anyone has any questions, there would also be serious data protection considerations with this. Thank you.
Thank you very much, both to Aislinn and Talia. I think that you are great. I'm learning a lot. And there are also questions on the Q&A, but I want first that Ansgar maybe is just reacting to all the input that you give to us. You are incredible. So Ansgar, please.
Yeah, this is a difficult act to follow. Thank you both so much. That was really great. I think I have not, in the economics world, come across people that understand the normative and legal side of things as deeply as you two, and it was really great to hear your comments. I just want to at the risk of revealing my complete ignorance of legal scholarship, I'm going to comment on a few points. So the first thing I want to say is I completely agree with Talia's point that different credit markets are special in different ways, right? So a lot of, basically everywhere in the world, credit markets are highly non-competitive, which is something we haven't modeled. And lenders might want to discriminate primarily on people's elasticity of demand or willingness to pay rather than credit risk. And I fully agree with that. And that's one of the things that people find most concerning about algorithmic pricing in other markets is that, for example, sellers who have access to your browsing history or other very detailed information about your habits might be able to exploit your willingness to pay more than in the old-fashioned world of advertising, right? And that generates lower consumer surplus potentially. And I think that's also true in credit, and it's just harder to measure because you'd have to estimate a demand curve at the same time, and the fact that estimating demand curves is hard is kind of the first thing that we show our students in undergrad econometrics. So it's very challenging, which is why we didn't really go there. But I totally agree. And I also agree that the involvement of government agencies in the US mortgage market makes it almost incomparable to any other credit market in the world because it's so pervasive. And so what we're not claiming here is generalization of our qualitative or quantitative results. What we're trying to do is put some tools out there that hopefully can be used in other settings, and that also goes to the question by Oliver in the chat about generalizing this. The other thing that Talia mentioned is there's several questions about what's the objective function, right? Like what is a policymaker or a court going to think about? Do they care more about acceptance rates or do they care more about pricing among the accepted? Do they, what type of triangulation is the most problematic? That was a really interesting question. Also, I would add a third point, which is that when you just look at the chart of acceptance rate across racial groups, it masks potential inequality within groups, right? It could be that the average acceptance rate for Black borrowers goes up, but that's just that's only driven by Black borrowers with a college degree, whereas all the others are getting excluded more frequently. Do we think would that not be problematic just because we can average it away, or is it still some kind of inequality, right? So that's, I know under the current law, I think race is the protected characteristic, so you would average everything within racial group away, but it seems like there's an open question there. In general, I think it's sort of like the current law does not give us answers to what the objective function should be, and I find it fascinating because at least as an economist, I would want to know the answers. So let me comment also briefly on Aislinn's presentation. I thought that was also really insightful. Yeah, I think one thing that's interesting is your point that the source of discrimination is not relevant if it's an indirect discrimination claim, which I agree with that. And one thing that we struggled with a lot when we're trying to sell this idea of decomposing flexibility versus triangulation was, what is it relevant for, right? And we steered away from taking a normative stance in the paper, but we wanted to think through that a little bit. And one thing we could think of is sort of a cost-benefit analysis. So if we're not thinking about an individual court case, but we're thinking about a policymaker who's trying to figure out whether the current discrimination framework, with all the costs that it involves, is doing its job, then the sources in this sense might also be important, right? So you might worry, for example, if everything is driven by triangulation, then new technology runs rings around the current law, and the current law is not really fit for purpose anymore, right? And so the cost of that framework might be quite big because there's a lot of court cases, etc., while the benefits are no longer so clear. And I think in that, so from this higher level perspective, I feel that it's interesting. And there's another example that you spent a lot of time on in your discussion that actually we also spent a lot of time on. It's not in the slides because it's mostly arguments between us and the referees that happened here. So it was exactly this case that your philosophy colleagues talked about, the perfect correlation case. So there is some combination, one variable or a combination of variables that is perfectly correlated with race. Now, is it problematic to put that in the model? And the problem with that in our language, it's triangulation, right? It's perfect triangulation, but it's also perfect flexibility, right? Because it's you predict race, but it's also a function of X that matters for default. So it doesn't, which one you call it doesn't really matter from the perspective of our decomposition. And so we had to caveat in the end that all that our decomposition gives us is sort of bounds on how much flexibility and triangulation there can be, right? So if we find very low numbers for the triangulation number, so we can say that triangulation is not the whole story, but that we have to stop there. And it's kind of, yeah, this is a really interesting question, I think. So how much, if perfect correlation is unlikely in the real world, but how much correlation are we able to tolerate when we're in suppose we're away from this case where X perfectly predicts race, or, it's clear that a pregnancy clause in a contract only applies to women. Suppose the correlation is 90% or 95% or 85%. At what point do we start to care from a legal perspective? I think that's very interesting. And I think that, yeah, there you also have to start thinking about this idea of upstream characteristics versus downstream that I hadn't heard before, but seems to me like exactly the right way to think about it. And so I'm very grateful for that.
Let me
add
just, yes, thank you very much. Let me add only, and I have a question on this regard, but is it not that this issue regarding triangulation in our framework, let's say economic framework, is solved via causality, by the distinction between causality and correlation? Because, you can indeed, if you prove that race is the cause of this result, then, even if you're doing this type of triangulation, then you're able to solve the issue. The problem is that when, as you say, it is not the cause race, but simply it correlates with something else that caused the result. So I don't know, at least this is how we, from the point of view of the financial economics, address issue on what are the main drivers for this type of different decisions. But maybe I'm just including more confusion than the one that we have. But I was really thinking that all these issues that we are having about triangulation, as you are talking about, are all driven by the fact that we cannot really pin down the causality. But, in any case, I think that I learned a lot. We are quite out of time. And, there are some other questions that are largely, let's say, specific. Of course, people are fascinated by the methodology, but, clearly, and I don't know if you want just to answer to this question, is the traditional model with logic the right benchmark to determine fairness issue? The old model could be biased as well. I think this is something that maybe you can comment, and then we are going to close.
Yeah, I agree that the old model could be biased as well. We're not claiming that there's no inequality with the logic. So it's kind of different from Talia's hypothetical court case, right? It's not like we're trying to say, here's the situation, is it fair or unfair? It's more like, in what direction does it move when the technology moves? And
so is it relative term? Exactly.
I think that's how I would think about it. But I also, Loriana, I think the causality point is very interesting. I think it's really hard to get a causal estimate of changing somebody's race, right? There are causal estimates out there of changing the other characteristics, right? There are people who have clever identification strategies for what happens when you charge people more interest, put a higher LTV, all these higher income, whatever. But it's all very partial and local, these estimates, right? So I can't tell you what the decomposition is into causal and correlational, and that if you thought that was a good way to set up the welfare question, it would still be super hard to measure.
No, of course.
That's why.
Yeah. Okay, so I want really to thank Ansgar and Talia and Aislinn. You did a great job. I'm leaving now the floor to Katja to conclude, but thank you very much from my side. I learned really.
Thank you so much for having me.
Well, thank you. I'm just as excited as Loriana was. And I think both the presentation of the paper and both of your comments show two things. First of all, how much there's still to think about and discuss in more detail. And second of all, which makes Loriana and me especially happy, that this is a really cross-disciplinary working relationship, so to speak, and where we have concrete questions to ask each other, and where it's not too complicated to explain to the other person, to the other discipline, what we're talking about. And lastly, I guess it's a topic. It's not only going to be credit scoring, it's going to be scoring more generally. And I think we will probably for years to come, we will probably think about this for years to come. And maybe we can use credit scoring as one of the answers for all the other scores we're going to be talking about. So thank you so much. Really happy to have you here, and look forward to continuing the discussion.
Yes.
Day or afternoon, depending on where you are.
Yes. Bye-bye to everybody.
Bye-bye. Thanks very much.
Bye.